studying your last two. I swim with tea when they turned in. The staring out to mute and can lend a pole that some kid died.
One of the most important concepts in corporate taxation is understanding that the tax payment deadline is different from the tax return filing deadline. Many beginners assume that both occur on the same day, but that is not the case. In fact, corporations are usually required to pay any balance of tax owing well before they are required to file the T2 corporate tax return. The process begins with the corporation's fiscal year end. From that date, the corporation generally has 2 months to pay any outstanding corporate income tax balance to the Canada Revenue Agency. However, the corporation usually has 6 months after the fiscal year end to file its completed T2 corporate tax return. This means that, in most cases, the tax must be paid first, and the return itself can be filed later. Because these are two separate obligations, they also have different consequences if they are missed. If the corporation does not pay the balance owing by the payment deadline, the CRA begins charging daily compound interest on the unpaid amount until it is fully paid. On the other hand, if the corporation files the T2 return after the 6-month filing deadline, the CRA may impose late filing penalties in addition to any interest that may already be accumulating on unpaid taxes. For this reason, professional tax preparers monitor both deadlines independently. The payment due date should never be overlooked simply because there is still time remaining to prepare and file the T2 return. Even if the return has not yet been completed, corporations should estimate and pay any expected balance owing before the payment deadline to minimize or avoid interest charges. A useful way to remember this rule is with the phrase, "pay first, file later." In most situations, the corporation pays its taxes within 2 months after the fiscal year end, and then submits the completed T2 return within 6 months after the fiscal year end. Keeping these two deadlines separate helps ensure full compliance with CRA requirements. The key takeaway from this slide is that paying corporate tax and filing the T2 corporate tax return are two completely separate responsibilities. Understanding the difference allows tax preparers to help their clients avoid unnecessary interest charges, late filing penalties, and costly compliance issues while maintaining an organized and professional tax preparation process. Although the general rule is that corporations must pay any balance of tax owing within 2 months after the end of their fiscal year, some corporations may qualify for an additional month to make the payment. This means that instead of paying within 2 months, they may have up to 3 months after their fiscal year end to pay their corporate income tax balance without incurring interest. The first requirement is that the corporation must be a Canadian-controlled private corporation, commonly known as a CCPC. If the corporation is not a CCPC, it does not qualify for the extended payment deadline and must generally pay its balance within 2 months after its fiscal year end. Being a CCPC alone is not enough. The corporation must also be eligible to claim the small business deduction. This deduction is available to qualifying Canadian-controlled private corporations that earn active business income within the prescribed limits. If the corporation does not qualify for the small business deduction, it generally cannot benefit from the extended 3-month payment deadline. Even if the corporation is a qualifying CCPC and is eligible for the small business deduction, additional CRA conditions must still be satisfied. These include meeting specific taxable income and taxable capital thresholds established under the Income Tax Act. These limits are designed to ensure that the extended payment period is available primarily to smaller Canadian businesses rather than larger corporations. A useful way to think about the decision process is as a series of questions. First, is the corporation a CCPC? If the answer is no, The payment deadline is generally 2 months. If the answer is yes, the next question is whether the corporation qualifies for the small business deduction. If it does not, the payment deadline generally remains 2 months. If it does qualify, the final step is confirming that all CRA eligibility requirements, including the applicable taxable income and taxable capital limits, have been satisfied. Only when all of these conditions are met can the corporation generally benefit from the 3-month payment deadline. The key point to remember is that the 3-month extension is an exception to the general rule, not the rule itself. Most corporations should begin by assuming that the balance is due within 2 months after the fiscal year end. The 3-month deadline should only be applied after carefully verifying that every CRA eligibility condition has been met. Taking the time to confirm these requirements helps ensure accurate tax planning while avoiding unnecessary interest charges and payment errors. The easiest way to determine the correct corporate tax payment deadline is to follow a simple step-by-step process. Everything begins with identifying the corporation's fiscal year end. Since every corporation can have a different fiscal year end, this date is always the starting point for calculating both the payment deadline and the filing deadline. Once the fiscal year end has been identified, the next step is to determine whether the corporation qualifies for the extended 3-month payment deadline. Begin by asking whether the corporation is a Canadian-controlled private corporation, or CCPC. If it is not, the balance of tax is generally due within 2 months after the fiscal year end. If it is a CCPC, you must then verify whether it qualifies for the small business deduction and whether it satisfies the CRA's taxable income and taxable capital requirements. Only after confirming that all eligibility conditions have been met can the corporation generally use the 3-month payment deadline. After determining the correct deadline, the corporation should pay any balance owing to the Canada Revenue Agency on or before that date. Paying on time prevents interest from accumulating and ensures that the corporation remains compliant with its payment obligations. Even if the T2 return has not yet been finalized, making an estimated payment before the balance due date can significantly reduce or eliminate interest charges. If the payment is made after the due date, the CRA begins charging daily compound interest on the unpaid balance. Unlike late filing penalties, which relate to submitting the T2 return after the filing deadline, interest is charged simply because the tax was not paid on time. The longer the balance remains unpaid, the more interest continues to accumulate, increasing the corporation's overall tax cost. Professional tax preparers follow several best practices to avoid these situations. They always verify the corporation's fiscal year-end first. Determine whether the corporation is a qualifying CCPC. Confirm eligibility for the small business deduction. Review the applicable taxable income and taxable capital limits, and ensure that any balance owing is paid before the payment deadline. Following this structured approach helps prevent errors and ensures that clients receive the correct payment deadline. The key takeaway is straightforward. Most corporations must pay their corporate income tax within 2 months after the fiscal year end, while eligible Canadian-controlled private corporations may qualify for a 3-month payment deadline if all CRA conditions are satisfied. By following a systematic decision process and paying the balance on time, tax preparers can help their clients avoid unnecessary interest charges and maintain full compliance with CRA requirements.